In this Hauseit tutorial, we will be showing you how to analyze the financial statements for a co-op. If you're watching this video, you're most likely a home buyer, but you could also be a real estate attorney or even a real estate agent. Real estate attorneys are the ones who are tasked with what's called buyer due diligence at the time of an accepted offer and prior to signing a contract. They will generally review the most recent 2 years of financials, as well as other building documentation such as the offering plan, the purchase and sublet applications, as well as the house rules. They may also review the building's board minutes if those are available. If you're a real estate agent, you're probably watching this video so that you can become familiar with how the due diligence process works, as well as, generally speaking, how to interpret financials. It's a very good idea to be able to review financials, even if you're not the attorney. If you're the buyer, it's a really good idea because ultimately you're the one who is putting your money on the line. So in any case, you never really want to rely on somebody else, but it's good to know that your attorney will review the financials for obvious red flags prior to advising you to sign the contract. Now, just a quick note before we go into the analysis. If you are a buyer, friendly reminder that your closing costs, at least in New York City, can be quite high, and it is possibly helpful for you if you'd like to try and calculate them. You can visit our buyer closing cost calculator by navigating to the calculators tab here on the top of Hauseit's website. Click on buy and go to buyer closing cost calculator. Quick preview of what it looks like over here. So you can put in your sales price, say 1.5 million. You can put in the amount financed, you can choose the property type, and it'll give you an overview of your buyer closing costs. You can see if you're buying anything else apart from a condo, or rather from a co-op, that the closing costs can go up substantially. If you're buying, for example, a condo, new construction, your closing costs are north of 5.5%. So just going back here, again, there's the buyer closing cost calculator. It's more likely that you're buying a co-op, and if you are, you can also look at the flip tax calculator for sellers. That'll give you a sense for how much you'll have to pay when you're selling. And also you have the mansion tax calculator, as well as the home affordability calculator, which also has a nifty ability for you to involve post-closing liquidity into your analysis so that you can calculate true affordability specifically for a co-op apartment here in New York City. So let's jump into the financials. This here is a sample co-op financial statement from a building here in Manhattan. The first thing you want to do when you open up your financials is to look at the independent auditor's report. Now, this is usually at the top of the financials, and what you really want to look for is the opinion section. And you want to make sure that they say that the financials present fairly in all material respects the financial position. You're essentially looking for caveats or carve-outs. Specifically, you don't want to see restrictive language such as subject to or except for. If you see anything like that, you're going to want to take a little bit of a deeper dive into the financials just to make sure that there are no obvious issues. So going back into the financials, assuming you've read the opinion, you can move forward. Now, a quick note, smaller buildings may not always have what's called audited financials. And so if a building's financials are unaudited, you're going to see a cover letter which says that the firm that's put the financials together basically has no opinion. That's totally normal if the financials are unaudited, and it's not necessarily a red flag if the financials are not audited. The reason being is they are significantly more expensive to prepare, and therefore many smaller buildings opt to pass on this added expense. So moving forward, the first thing we may want to look at is in the balance sheet. We want to figure out how much in cash equivalents, and reserve fund a building has. The way for us to calculate that here is to take the cash and cash equivalents of, let's say, 91,687, and we want to add that to the reserve fund amount of 1,472,640. Now, if we sum these up, we're going to get a total which is 1.564 million. Now, what we want to do is we want to figure out how many months of operating expenses can this building support using that total we've calculated. So if we jump into the statement of operations, also known as the income statement, we're going to see that the total cost of operations is 1.965 million. So if we take that number and we divide it by 12, we're going to have an annual operating expense, rather an annual monthly expense of 163,000. So we would take the amount of our reserve fund and cash equivalents, divide that by the monthly operating expenses, and we're going to come up with 9.55 months. There we go. So clearly this is pretty healthy, because what we're really looking for here is a building to have at least 3 to 6 months of operating expenses in terms of their cash and cash equivalents. So that's definitely a pass. The next thing we want to do is we want to go back into the statement of operations, and we want to analyze the composition of the revenue. Specifically, we want to check and see if there's anything that is contributing to the revenue that is potentially non-recurring, potentially volatile. Now, in this case, the majority of the revenue does come from the maintenance collected from each co-op shareholder, unit owner, and that's positive. That's the most recurring revenue and the most stable revenue, and primarily that's because co-op does have board approval for applicants, and they have, on average, very strict financial requirements. So it's much more stable to have most of your revenue coming from maintenance than coming from, say, a flip tax, coming from, commercial rent or anything else that is less sticky. Now, that being said, in this case, the building does have commercial rent, which is greater than 10% of the total revenue of the building. So whenever it's more than 10%, that is something you want to look further into. It's not always a bad sign, but it is warranted for you to look into these line items further. Specifically with the commercial rent, we'll talk about it later, you're going to want to go in the notes section of the financials, and you're going to want to see how long is that lease term, what's the rent, what's the renewal provision, when does it mature, so on and so forth. Because if you think about it, if something happened to this commercial rent line item, the building's revenue would drop by 300K, which would bring the revenue below the cost of operations. And whenever that happens, you would be eating into the reserve fund, or the building may be levying an assessment on unit owners. So if you're about to buy in the building, you definitely want to figure out if you're at risk in any way with regard to something such as this commercial rent item. Now, also we see that operating expenses, operating assessments, are also comprising about 10% of total revenue. Now, I have a hunch here that this operating assessment is actually what's called a condo or co-op tax abatement assessment, which is very normal for a co-op, but it is something worth exploring a little bit later on. Now, next thing we want to do is we want to go into the balance sheet, and we want to check and see what is the deal with accounts receivable. Is there anything that is unusually large, anything that is worth analyzing further? Now, in this case, there is a line item here that says due from commercial unit owner, $100,000. Now, if we think about it, $100,000 relative to the expenses that we have every year of 2 million is still a fair bit of money, right? It's not 10%, but it is closer to 5%. And I'm personally curious why that is the case, that the building is owed 100K from the commercial unit owner. It could very well be nothing. It could be perhaps maybe quarterly or semi-annual payments for the rent, something like that. So it might not be an issue, but it is certainly something that would be a good question to ask the building's management. Now, the next thing we want to do is we want to also check the notes for whether or not the building has a mortgage. So if we scroll down here, we're going to go into the notes to the financial statements, and we can go down and we can check in the mortgage section. So the building doesn't appear to have a mortgage. It looks like they opened the mortgage in 2015, and it looks like they initially started with 1.5. They took out an additional $1 million. Now, it looks like the monthly payment is 24K, and there's some sort of amortization schedule. It matures in 2026. So if we look here, it's telling us what principal payments are required. So every year for the next 5 years, the building has to pay around 250K for amortization of the loan. So that's not necessarily an issue. We may just want to think a little bit about how they're going to get this cash. So if we go into the statement of operations, right? So their revenue is 2.2 million. The cost of operations is 1.965, but there's no mention here of the implications for paying down the mortgage. So what we could certainly do is we could check the cash flow statement. Let's find that. Here's the cash flow statement, and if we check here, we should see something about the amortization of the loan. So here it is. So here's the amortization of the mortgage payable, and we still have a net increase in the cash and cash equivalents on an annual basis. So don't think there's an issue, and also worth mentioning again that the building has $1.917 million in total current assets and the reserve fund. Now, given 100K of that is accounts receivable, which we've talked about, but still, in general, this building has well north of 1.5 million, so it looks like they could comfortably cover any amortization payments for their mortgage. Now, the next thing we want to look at is the actual notes. So I want to go back to the note section of the financial statement. And we talked briefly earlier about the commercial rent and the risk associated with a renewal or a vacancy with regard to the commercial space. So here it breaks down the situation. Very clearly, there was an initial lease term for 25 years, which had a fixed annual rent, plus a real estate tax escalation clause. Looks like the master lease agreement is currently in its first renewal term, which extends through 2030. So clearly there's no renewal issue, and presumably they've had this same commercial operator for a very long time, and presumably there have not been any issues. So this appears to be a very low risk situation. Now, looking further down, we did talk a little bit about the reserve fund. One thing that is interesting in regard to this reserve fund, you'll find that majority of the reserve fund is held in one bank's money market account. So if we read further here, you'll actually find out that the building does require, or rather the bank does require, that this company right here must maintain a deposit account at the lending institution in a minimum amount of $175,000. So clearly perhaps the interest rate on the loan or some other terms were sweetened by way of requiring the co-op to put their money in that one particular bank. The only thing that we notice here, though, is obviously this amount is above the FDIC insurance limitation. So that is possibly a very minor risk. Now, bear in mind, I don't believe any bank has ever gone through the insurance limits, and I don't think any individuals have lost money in recent memory. But nonetheless, there is a remote risk here that, probably a little over $1 million of this money is basically uninsured. So going forward, we can look a little bit about the property improvements. So in this case, this is telling us kind of what repairs and improvements were done. And it also gives us here a projection that the corporation is planning on spending $600K to complete some sort of project for the sidewalk and vault. Most importantly, it says that the corporation anticipates funding this capital project from existing corporate resources. Now that's really important because it tells you exactly what their plan is for paying for this project. We already know that they have a very solid reserve fund, and as a result, it's not surprising that they don't really have any issue in figuring out how to finance this particular improvement project. Going a little further down into the notes, we'll see here that Note 6 talks about operating assessments. And as you'll recall, there was a pretty substantial line item for assessments in the income statement. Now, what appears to be the case here is that the corporation's policy is to refund abatements granted under the New York City Cooperative Shareholder Real Estate Tax Abatement Program. Basically what this means is if you live in New York City and you're a primary resident and you own or occupy your units in a condo or a co-op, you are entitled to a tax abatement of around 17.5% of your annual property tax bill. Now, if you live in a condominium, you're paying your taxes directly to the municipality, and therefore, when you receive this discount, you basically have a lower property tax bill. But with a co-op, because the co-op corporation pays the tax on behalf of all owners, it means that the abatement money comes back to the co-op. And what most co-ops do is they basically calculate an assessment and they charge that assessment to unit owners in the exact amount of the abatement being received. So in a sense, although it's technically an assessment, it's not a bad assessment because the owners don't actually have to physically take money out of their pocket. Now they're obviously losing money that in theory is theirs, but it is completely normal, and the vast majority of co-ops, they actually do this as a way to mitigate increases in costs over time, such as increases in real estate taxes and increases in utilities, as well as payroll for staff of the building. Note 16, or rather Note 11, is also a very important one. Now this talks about claims or litigation. It's never a good idea when a building has litigation because of the uncertainty, specifically regarding the cost of representation, attorneys, issues with your insurance. Will this cause an increase in premiums over time? Not to mention any potential settlement or monetary loss associated with the litigation. So this note here gives us some degree of comfort. It says here specifically, in the opinion of management, claims or litigation outstanding are either without merit or the ultimate loss, if any, would not have a material adverse effect on the financial position or results of operations of the corporation. So again, that's a very positive note for you to evaluate. One other mention here in the notes, or possibly somewhere in the financials, it does tell us whether or not the maintenance has increased recently. And so we're going to try to find that real quick. Let's see if we can find it. So here we are in this section, revenue. It does tell us that there was a 4.5% increase effective January 1st, 2019 for the monthly maintenance. It is also giving us the projected operating assessment, which is again related to that cooperative shareholder real estate tax abatement program we talked about earlier. Final note here at the very bottom of the financials, as you go towards the end, it says that there is a supplementary piece of information about the financials. And very important, it says here basically that this part of the financial statement is unaudited and it's really only provided for the purpose of additional analysis. So worth here taking a look. Again, so this is our budget and this is our actual for the most recent year. Just to summarize, we talked a little bit about maintenance, the fact that it's very sticky and it's very good to have the majority of your income come from maintenance. We looked at the annual increase in the maintenance. We also analyzed the commercial rent. We took a look at the lease terms just to make sure that there's no risk there or minimal risk. We also talked a little bit about the operating assessments and how and why those are levied. In terms of expenditures, we looked at the capital improvements that were done in the prior year. We also discovered that the building is planning on spending $600K for a sidewalk vault repair project this coming year, and that they have already basically generated the funds to pay for that, in part through the presumably existing reserves and cash balances that they have. We also looked at mortgage amortization. So the building does have an existing loan. We looked a little bit about the payment for that amortization schedule. We checked the cash flow statement as well for the most recent year to reflect the fact that the building has been amortizing down some of their loan. So that's pretty much the overview of building financials for a co-op. If you have any questions, leave us a comment below the video. But otherwise, certainly encourage you to ask your buyer's agent or the listing agent for financials for any building in which you're thinking of buying an apartment. Good luck out there.